So what's going on here is that the Fed and the Treasury are working together. It's almost like, it's getting to the point where the Treasury is going to be buying its own paper, and it's working with the central bank. No central bank independence, really. And that's not good for the dollar. We're entering hyperinflation or currency collapse territory. Thursday, May 2nd, 2024, Maneco 64, home of alternative economics and contrarian views. So the Fed has added almost $500 billion of liquidity. Yes, they did not change interest rates, but they have accommodated. And at the same time yesterday, you might not have seen it, the United States sanctioned a few Chinese companies. Yes, they did. It didn't take that long, right? And I think that's going to continue to hurt the Treasury market. It's going to continue to hurt the dollar. So that's what we're going to look at today. And before I do go deeper into those subjects, I just wanted to say something about what's going on around the world, especially in the West. Not just economically, financially, but socially and politically. And one can get bogged down with all the bombardment of news and chaos and all the bad things that's happening. And it can get you down. It can get you into a bad kind of emotion, fear. And we're all like victims to that, of course. We can't live outside the world. But one thing I would say that has helped me is to try to focus on what I need to do in terms of what I do every day, like producing content for you. And hopefully when I get a bit more fit after my surgery, play my golf, take Rudy out for walks, yes, go out with my wife and do things with the family. Yes. So what I'm trying to say here is try to ignore all the noise and stuff. And why? Well, because there's very little we can do to solve the problems of the world. We can just focus on ourselves and do the best we can. I think that's the way to do it. Yes, there are ways to fight all the policy errors out there, all the inflation, all the taxation. It's not perfect, but there are ways to do it. And that's, I think, what people should focus on. It's just my opinion. I don't know all of you, of course, but we are all in different circumstances. Yes, just focus. Don't try to get too bogged down. Anyway, back to the Fed. Yesterday, I said the Fed was in a bit of a difficult situation, and I think it still is. The markets are still clamoring, I think, for even more accommodation. We saw the stock market react relatively well after the announcement and the press conference. They went up quite a bit, but then all those gains fizzled out at the end of the day. And I see that this morning the markets are up, but not that much. So my feeling is that the Fed, what they need to do now is to take the foot completely off the brake. And what do you do when you take the foot off the brake in a car? Well, usually you accelerate again. You put the foot on the pedal to accelerate, to keep moving. And I think we're almost there for the Fed. It's called the so-called pivot. So they announced yesterday that they're going to slow down the amount of QT for their Treasury securities from $60 billion a month to 25, which is a difference of 35 a month. You multiply that by 12, you get 420 billion extra liquidity. And that's why I said they added almost $500 billion. And there's a post here on X or Twitter from Richard Whalen, who actually worked for the New York Fed, but he's now an independent analyst. And this is what he said about what happened yesterday. Slowdown in balance sheet runoff means a greater add to reserves. Bank deposits, excess deposits bigger than MBS purchases by banks. Crowd cheers. Here's your cut, folks. Thank you. That's what he said. So, of course, a lot is going to hinge on what's going to happen tomorrow in terms of the jobs data. I think that could be pivotal if we see a much weaker than expected jobs number and a higher unemployment rate, for example. We could see the market go through the roof, kind of accelerate a lot higher. And why is that? Well, because it's going to force the Fed's hand maybe to consider even cutting at its next meeting or being less hawkish, so to speak. Because Powell yesterday said, and the Fed, the FOMC said, they're going to stay higher for longer rates. But I think they're desperate to accommodate. And the other thing that we noticed yesterday is that the U.S. Treasury is working together with the Fed, it seems. They're doing some kind of de facto yield curve control. And Sven Henrik, the Northman trader, tweeted this out or posted it. He said, I do the buybacks, you taper QT, and we worry about inflation later, right? So that's Yellen talking to Jay Powell. So what's the buybacks all about? Well, that's the U.S. Treasury selling long-term paper and getting the proceeds and buying back short-term bills to keep term rates low, to keep the financing for the Treasury lower. The danger with that is that rates stay elevated for longer or even go up eventually, and the Treasury is left in a bind. So what's going on here is that the Fed and the Treasury are working together. It's almost like it's getting to the point where the Treasury is going to be buying its own paper and it's working with the central bank. No central bank independence, really. And that's not good for the dollar. We're entering hyperinflation or currency collapse territory. So that's how I see it. And in the middle of all the commotion, all the talk about what the Fed did yesterday, the U.S. Treasury quietly came out and announced that they've issued some more sanctions and that not large, but some Chinese groups were included. Not banks yet, but I think that's going to be coming soon. And you can bet the Chinese are very much aware of that, the Chinese government, even though these sanctions were against smaller Chinese companies. So the FT says here the U.S. has imposed sanctions on more than 300 Russian and international entities, including some in China and Turkey, for providing support to Moscow's military as it wages war in Ukraine. The fresh measures reflect Washington's increasing concern about China and other countries providing critical inputs to sustain Russia's military-industrial base. I'm going to stop right here. Suffice it to say, I don't think that's going to work very well for the West or for the U.S. We've seen how the sanctions on Russia have not really helped that much. The Russian economy is doing well. If anything, it's pushed the global South and the BRICS nations to find alternatives, and they're going to continue to do so. And you might ask, well, Mario, aren't you against Russia and what they did to the Ukraine? Well, I'm not talking about that. I'm not taking sides. I'm just looking from the outside at what's happening. And the way I see it is that non-Western countries, they might be asking the same thing. Why are you giving so much to the Ukraine? You just gave another 61 billion. You've probably pumped more than 200 billion into Ukraine. We should maybe sanction you too. That's how they see it. And they see this as arrogance, that the U.S. can stop nations that are not at war with it from trading amongst themselves. And that's why I think this is going to be really bad for the dollar system, for the petrodollar. It's going to make things even worse. So yes, that came out yesterday. And I would argue that one of the reasons maybe the Fed hasn't been able to cut the Fed funds rate a little bit is because of this, because it would hurt demand for treasuries and the dollar even more, even though I don't think, even if they raise rates to 8 or 10%, that countries like China and others in the global south would be attracted to treasuries anymore, because it's not safe. Your treasuries, your reserves can be frozen and ultimately confiscated by the United States and maybe even the EU. So Sven Henrik said, we worry about inflation later. Well, it's coming, guys, and that's why I'm still continuing to stack gold and silver whenever I can. And just wanted to remind you that Miles Franklin still has the special for this week. They're charging less than 3% over spot for 1 ounce gold Australian kangaroos, $59 over spot, and only $3.10 over spot for 1 ounce silver Krugerrands. And if you want to get in touch with them, email them at info@milesfranklin.com or call them on this toll-free number, 1-800-822-8080, and mention Mario or Monaco64. And for my UK viewers, if you're thinking about stacking or you have been stacking, don't forget to give Oliver Temple and Simon Temple a call at Gold Investments. And why Gold Investments? Well, because I've been dealing with them for over 20 years, used to deal with their father. And I think it's really important to know who you deal with, that they're reputable. Gold Investments has been in business since 1981. So I have some specials there as well, or they have some specials for you. Just check the description of the video below. So let's quickly look at where the markets are then this morning. It's just gone past 8 a.m. London time. As I said, the stock market, the gains after the FOMC fizzled out at the end of the day. Markets were unchanged to lower, the major indices. Gold and silver actually rallied well. They came off the highs, but gold traded to a low of 2281, I think, yesterday, and we closed above 2300. Right now we're at 2315, down about $4. The high's been 2326 and the low 2312. Silver, yeah, we got close to 26 yesterday, and then after the FOMC, we almost went up to 27, just below 27. Yes, we've come off a bit, but we're still at around 26.60, down about 9 cents. High overnight has been 83 and the low 45. And as I said, the stock market hasn't really picked up that much. The Dow is up 130 points, which isn't really that much, is 1/3%. Same thing for the NASDAQ 100. It's up 0.5%, and the S&P is up just under 0.5%. So as I said, I really believe the market wants to see more in terms of accommodation from the Fed. And that's why tomorrow's number is going to be really important. And the numbers coming, out in the near future. The currencies haven't really done much. Yeah, the dollar yen is still quite volatile. Dollar has come off a bit. I mean, it traded down to almost 154, but we're now back above 155. So just a lot of volatility right now in the dollar yen. I notice here that WTI crude has come off a little bit. It's below 80, even though it's up 0.5% overnight. We're at 79.20. Brent is at 83.86. Copper is up 0.2% at 4.57. And last but not least, and this is really important because the banking sector is in trouble and there's very little liquidity out there. And that's why the Fed cut down on the QT, because it helps the banks and it keeps Treasury yields from rising. And Treasuries are a big part of banks' balance sheets. And the more yields rise and Treasury values decrease, the worse it is for the banks. So yes, the 10-year dropped yesterday from around 470 to around 460. Right now we're at 461. And I noticed the 2-year as well came down from above 5%, and we're now at 495. So yes, yield curve control is here, and both the Treasury and the Fed are doing it. And as I said, this is not good, guys. This is hyperinflationary territory when the central bank and the Treasury are coordinating things because the debt is getting out of control. And that's what's going on. And that's why I'm going to hold on to my precious metals and my hard assets. And I'm going to try to keep as little as possible in terms of savings in the bank on any kind of deposit. So with that, I'm going to wish you all a very good day. Take care. Bye.